In this video, I will show you 3 high-quality stocks to buy in 2025. I think these stocks are very well positioned for the future, and I think the earnings of these companies will grow a lot in coming years. So I think these are great investments. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25%, and I own these 3 companies. Okay, so I will be biased, obviously. Do your own due diligence. Let me start with the first one. I think for the coming years, so starting in 2025, LandBridge will be a wonderful investment. What does LandBridge do? It's very simple. They own some lands in Texas and they manage the lands. It's a very capital light business model like TPL, Texas Pacific Land. Maybe you are familiar with TPL. They have 90% margins. They have strong revenue growth. They have strong earnings growth. And if I compare to their biggest competitor, TPL, look at this, beautiful margins. They just manage lands in Texas. And you see that for their biggest competitor, the revenue is going up and to the right, net income is going up to the right. I think this is maybe the best business model on earth. So now I will talk about LandBridge. I don't have the same charts for TPL and for LandBridge for the simple reason that LandBridge went public last summer of 2024. So definitely it's recent. You don't have a lot of information over there, but I did the work, and even if you look at the charts, you don't have any value. So I did the work, and they grow massively. In 2025, they are planning to grow their EBITDA by 70%, which is great. Basically, the story for LandBridge is very simple. They have lands in Texas, and it turns out that you have water infrastructure in Texas that is built on their lands, and they will welcome some data centers in Texas. As you probably know, AI is a real thing. AI is not a fad. AI will be very important. You will have way more data centers built around the world, especially in the US. And in big data centers area, Virginia, you have a lot of time. It takes a lot of time to build these big data centers, so you need more capacity now. And Texas is a beautiful land to build new data centers. And LandBridge will welcome this new data center story, this build out, because they already do it now. And the plan for LandBridge is very clear. They want to have powered lands. They have the lands, 90% margins, 0 costs, because they don't even manage the lands. They just have around 300,000 acres of lands, and they will welcome people to build infrastructure, water development, water transportation, roads, facilities, data centers, and they will get royalties out of all this development. They will get a royalty revenue coming out of all what is happening on their lands. So the business model of LandBridge is very asset light. They will enjoy 90% margins. And let me repeat, this is a business that will grow 70% in 2025, and they plan to continue to grow very fast. Maybe not 70%, but they plan to grow more than 20%. And it's a very small company, very young company. Not a lot of people know LandBridge at the moment. And if you look at the charts here, you don't have a clear picture because they went public last year, so you have costs associated with the IPO. So I would adjust these numbers. If you adjust the numbers, this is very clear. For 2025, they plan to have around $180 million of EBITDA that will convert to approximately 125 million of free cash flow. And if you look at the market cap of LandBridge, is not that high. Now, if you go to Guru Focus, you will see a market cap of roughly $2 billion. It's wrong. Just if you continue your due diligence, it is wrong because you have Class A shares, Class B shares. So actually you can go to Seeking Alpha and see the real market cap. Now the stock has rebounded in the past 2 weeks. So the market cap is becoming $5 billion. So that's very simple. You to get the price to free cash flow, you get 5,000 divided by let's say 130 million of free cash flow. You have a price to free cash flow of 38. Okay, you will say that's not cheap, and I agree with you, but they plan to grow 20% or more for a high quality business with amazing margins. So you have a price to free cash flow of 38, but in 2025, 2026, 2027, this is very likely that the free cash flow will continue to grow. I mean, I started this video showing you TPL, right? Showing you how big it can grow, how fast it can grow, how big it can become. So the runway, if you own lands, is immense. So just so you know that you get some value out of this video, the land business model is very profitable, very high margins, very not capital intensive at all, and you generate a lot of free cash flow. You have a free cash flow conversion that is completely insane, and you can reward shareholders with that, with dividends and buybacks. And LandBridge's management has understood it. They start to give some dividends now. So that's the story. Maybe that's not very clear at the moment. I will maybe do another video for you for LandBridge. But the story is very simple. They have an amazing runway. And if AI data centers are bigger than expected, we will see a lot more demand to build data centers or anything related to AI, energy. And it turns out that now we have some studies in the US that came out saying that the demand for AI is higher than expected. We need to build out these infrastructure plays, data centers, because we need a lot more energy. So some companies, I think Amazon is thinking about the nuclear energy. Some other companies are doubling their capex. We've seen the news from Microsoft that they plan to double their capex when it comes to data center. Look at it, Microsoft data center, 80 billion. Oh, sorry, that's in French. This one, Microsoft to spend $80 billion on AI data centers. It's 3 days ago. You have big companies, the Magnificent Seven, that is doubling down on big data centers, big AI play. And in the past year, the capex, the data centers investment from Microsoft was $40 billion. So literally, Microsoft is doubling its investment in data centers. And LandBridge is a play around data centers without the cost associated with the development, because LandBridge will just enjoy the royalties, the growth with high margins. So you don't have a business that is unprofitable, at risk. It has a risk-reward ratio that is one of the best opportunity you can get when you want to believe in AI and bet on AI. So that's why I started this video with LandBridge. If you think that AI will continue in coming years, LandBridge may be the best opportunity you may have. And that's a high quality name. You can't disrupt them. So you can hedge yourself and own LandBridge and TPL, but TPL has a higher valuation. I mean, for LandBridge, we found a price to free cash flow of 38. That is not cheap. For TPL, we have a price to free cash flow of 80. Oh, that's not the forward period, that's for 2034. So let's say it's 70. Still, that's very, very high. Price earnings ratio for TPL is 50. And we have a slower growth. So maybe you can own both of them. If you want to make a big bet on AI, I would highly recommend to monitor these companies. And these stocks move fast. The stock IPO'd in summer 2024 and tripled, and then sharply declined like 35%. And here I heard a lot of stories saying that they will not make any revenue, the growth too expensive, and now the stock rebounded. You know what? I added more shares here, and the stock rebounded in the past 2 weeks. So I hope it continues to go down so I can buy more. I think for the next 5 years, if I don't buy now, I will regret it. Frankly, this is what I think right now. If I don't buy enough LandBridge shares right now, in 5 years, I'm afraid I will regret it. So for the sake of regret minimization, I have to buy more of this. So I am looking forward for the stock to decline a little bit. Okay, let's continue. The next ticker symbol, I already gave you two for the price of one. So TPL is not included in this list. TPL is a little bit expensive at the moment, so I will not touch TPL right now. If it drops, yes, but not. So that was for the first stock, high quality stock to buy now in 2025. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. For the second stock to buy, I would say Meta has some good opportunities of increasing its growth. You all know Meta platforms. You all know Facebook, Instagram, WhatsApp, the VR headsets. You know how it works. You know it's a big company. You know they have a market cap of $1.5 trillion. But what you don't know is how fast they can grow. This is completely... they have an untapped potential, untapped pricing power. They can go into other geographies, other markets, and it's a copycat machine. I won't introduce Meta platforms. You know the platforms. You know the different software. You have a business with very, very high margins, even compared to Google or Microsoft. The margins are just very, very high. Operating margins of 40%, net margins of 30%, including the losses with the VR headsets. So if in the coming years, for some reason, the losses of the what's the name of the segment? Reality Labs, VR headsets. If the losses don't grow exponentially, like we are seeing right now, the margins are likely to go up. And we have this for a P ratio of 25. If you look at the charts for Meta platforms, it's absolutely beautiful. Absolutely beautiful. It's up and to the right, very profitable. And in 2022, the company had a lot of problems. They did some mistakes. And now the company is rebounding sharply. They are net cash. They don't have much debt. They do some buybacks. Now they pay a dividend, and the return on invested capital is above 20%, which is great. And for 2025, I see a lot of opportunities in terms of pricing power, in terms of more impressions, price per impressions. They have copied Twitter, and now they have Threads that they can monetize. They completely copied Elon Musk and X, Twitter, so they can monetize Thread. Now they announced recently that there will be a partnership between Facebook and eBay for the marketplace. I'm telling you, the marketplace segment of Facebook, if you go to the app on Facebook, sometimes you see the marketplace. It was not very well run. That's the best I can say. It was quite bad, no growth, no profitability. So I think the partnership with eBay can drive more revenue for Meta platforms as a whole. So you have some growth opportunities. Let me not talk about everything. Let me tell you some key stories about why I think the revenue for Meta platforms is likely to boom in 2025. First, revenue growth globally, because of more users, more monetization, Instagram, Reels, all the monetization. Second, the Threads monetization, the Twitter equivalent of Meta. 3, the eBay marketplace. 4, AI implementation. Also, another big thing that will happen to Meta, and I forgot it when I recorded the video, so here I are, is that they completely stopped the moderation, okay? They said that they don't want to have a censorship on the platform, and we want some free speech. So the way the Meta platforms ecosystem will work will drastically change in the name of free speech. So over the past 10 years, the company has been investing heavily in moderation, censorship, well-being of users, and now they said, no, screw it, we will just cut this stuff. We will move our headquarters from California to Texas. We will completely change the moderation stuff. We will not have moderation in the name of free speech. So we will have fake news, yes, but we want freedom of speech. So you will have a major change in efficiency. And I read somewhere on Twitter that there are maybe more than 40,000 employees that are working on the moderation segment in Meta. At Meta. So that's 40,000 people that may get fired or maybe replaced to another section of the market. I don't know. But maybe they will fire some people. And if you fire some people, you reduce your costs, and if you reduce your costs, you improve your margin and efficiency. So maybe this is a big move. I don't know, we don't know, nobody knows for the moment, but maybe in the coming years, they will reduce the workforce about moderation. This will increase the margins drastically, and the stock will be even cheaper. The earnings will grow a lot in the future years. So that was really important to say. The moderation will change. It's very likely that other companies will follow this move, but this, I don't know. We will see in 2025 how this impacts the profitability. It's likely that you will have some restructuring costs, but for 2025, late 2025 or even 2026, we may see some big margin improvement when it comes to SG&A costs. So improvement of EBIT margins, net margins, etc. So a lot of profitability coming out of this change in moderation. One key thing that could definitely help Meta Platforms is TikTok ban. The TikTok ban. For the moment, we only have rumors that TikTok will have some issues and will be maybe banned. We will see. We will see in 2025. We will see if the sponsors, if the marketing guys don't want to spend on TikTok and have the remaining part of their marketing budget on Instagram. That can be it. You have definitely some growth opportunities that will continue to drive efficiency for the business. I remember in 2022 when nobody wanted to touch Facebook. I remember when Mark Zuckerberg was telling us about AI investments, AI. Before AI was a real thing, before we had ChatGPT. And strangely enough, people mocked him, saying that, yeah, you have to drive up efficiency, don't talk to us about AI. And now they have become quite a leader in AI efficiency. They have their own algorithms. They don't rely on Apple, on the third-party data, cookies. They do their own stuff, and the runway is immense. And Mark Zuckerberg is definitely one of the best CEO of the world. I would say in the top 5. And he's only in his late 30s, or maybe he's 40 years old, so not likely to retire soon. So a lot of runway, amazing management, amazing CEO, some good growth opportunities, no debt problem, a lot of cash. Now they do some dividends, now they do some buybacks. The profitability and efficiency is likely to continue, especially with AI, and they will be the best in the social media industry. They clearly don't have competition. They had TikTok in the past, but they copied it with Instagram Reels. They had some competition with Snapchat in the past, but Snapchat is not the same growth animal. So now they are the only one. And because regulation increased a lot for Meta Platforms, for the social media industry, the barriers to entry are extremely high. A new startup from the Silicon Valley or anywhere else, a new startup can't really compete with Meta Platforms. Meta Platforms is the clear leader by far, and even if you are a young company and you want to invest $50 billion into the competition with Meta Platforms, how do you do it? You really can't. You can't compete with Meta Platforms. So Meta Platforms is very likely to keep its major leadership, over the next coming years. And that is the reason why they can have this pricing power, more efficiency, invest in themselves. They know they are the leader by far. So the market cap, I started with this. The market cap is $1.5 trillion. I don't see why it can't go up to $3 trillion. I mean, this is a company with 3 billion users in the world. Almost everybody is part of their family of apps, and you have this company trading at a PE of 25. That's it. The story is quite simple. It's not extremely cheap, it's not extremely expensive, but the growth is here, the management is here, the efficiency is here, the profitability is here, the margins are here, buyback, dividend, whatever you want. This is a simple investment idea that I'm giving you today. The third one is related to Meta Platforms, but not exactly. It's Amazon. And the bet I'm doing on Amazon, I bought some shares recently at around $200. the investment I make on Amazon is not for their e-commerce, is not for their cloud specifically. It's just that first, Jeff Bezos is back on the business, and second, AI will help drive efficiency up for Amazon for all their segments when it comes to their marketplace or even cloud or anything. There you have AWS, anything, any segment will be helped by AI by a lot, and this will drive efficiency and margins by a lot. And now we see it on Google Focus. Can I see the different segments? Okay, here at the left you see the operating revenue by business segments. Okay, you have the online stores, we all know it, it's no margin business, but it takes a big amount of the revenue. Third-party seller services, the margins are okay, but that's not it. And now you have this in yellow, Amazon Web Services, AWS, that's only 15% of the revenue. And this one, advertising services, that's 8% of the revenue. These two segments have very high margins. They have very, very high margins. And these two segments are growing the fastest. So it's very likely that over the coming years, these two segments will not be 23% of revenue, but 30% or 40% or even more. And because these two segments have very high margins, it will boost the global margins for AWS. So if you think in terms of valuation, PE ratio, the earnings will grow drastically for Amazon. The efficiency will grow drastically. Now we're talking about a forward PE ratio of 35. I think that's a little bit lower, taking into account the growth in this high margins segment. And now you may say Amazon is a little bit too big. It can't grow to the skies. It's $2 trillion of market cap, so it can't really be that big. And I'm telling you why not. I mean, as they grow into bigger markets, other markets, new markets, AI markets, the TAM grows. The total addressable market, the TAM is growing. So you can be the leader, a big behemoth, and if your TAM grows, your revenue can grow accordingly. So actually, if you think with this lens, Amazon is not too big because the TAM for AI, the internet, is more than $10 trillion. So you have runway. Amazon can double. And Amazon has done some acquisitions in the past. They are everywhere. So what is the TAM for the world? I mean, this is a bit too extreme, but you get my point. As they grow into many different markets, the total addressable market grows. So the runway grows. So the runway is immense for Amazon. And I wouldn't be surprised if over the coming 5 years, the stock continues to go up, the revenue continues to go up, earnings same thing, and earnings will have beautiful margins. I mean, the business will have beautiful margins in the future. That's my guess. And that's the reason I have this on this list. This is definitely a high quality stock, high quality management, high quality company. The market doesn't take into account the big growth runway that the business has. Jeff Bezos is back. AI, efficiency, margins, two big segments like the advertising in AWS that will grow the global margins for the business. You have a lot of runway. I think these three businesses that I've talked about today will be big winners for the coming years. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.